and welcome. You're watching NDTV Profit. I am Mahima Vachhrajani. Hatsun Agro is on focus today on the backs of Q3 earnings. The number look really positive, and we have with us Mr. RG Chandramogan, Chairman of Hatsun Agro, with us today. Mr. Chandramogan, congratulations on the extremely positive numbers. The numbers look quite good operationally. Just wanted to know if they've met your internal expectations. Also, we've seen double-digit volume growth, double-digit growth overall. Can you just give me the bifurcation in terms of volumes and pricing that has given this kind of growth to you?
See, this particular quarter has been doing it well without the commodity sales. In the last 9 months, in the last year, we have done a commodity sale, that is milk powder and other things, to a tune of 400 crores, which this 9 months we have done only 100. And the best of the quarters are yet to come because we have accumulated the stock. And last year probably it was inflation which was really hitting us on the wrong side. Now the inflation is under moderation, and these numbers are likely to only improve further from here.
Okay. And also just an idea about the segment-wise breakup, if you can just give me some kind of breakup. I believe ice cream is one of your products with the highest margins. If you can just give me what kind of breakup did you see in this quarter?
See, ice cream is heavily affected this particular season because of the heavy rains, storm after storm coming and hitting the shores of entire South India. So segment-wise, probably I don't have the numbers right now, but probably ice cream has been affected. We expect the ice cream to do better in the month of January, February, March.
Okay. And also the milk prices have been quite volatile, and we've seen that last quarter there was a shortage in terms of milk supply as well. Has this quarter been better in terms of that, both prices and in terms of supply?
No. See, last year the prices were volatile, not this year. Actually, last year the prices were up because we came out of 2 years of COVID and the demand picked up and the milk supply didn't pick up. Actually, the animal was not equipped to just give so much of milk. That created a lot of inflation last year. That inflation has to be adjusted in selling price. That was happening during this period. It didn't happen the way that normally it happens. This year, probably we don't expect inflation. There is a milk surplus available. And we already hit more than 40 lakhs liters of procurement. So we have enough stock and the cost is under control.
Okay. And in terms of margins, we've seen that your margins have been approximately 11.2% for this quarter. Do you plan to maintain these margins going forward, or do you think that your margins will increase in the coming quarters?
Coming quarter, it can slightly be much better than what this particular quarter is, because probably our ice cream and curd sales will improve in the month of January, February, March compared to this season. We don't expect purchase prices to be volatile. So hence, probably the margins can be a little better than what it is. And the sales should also be better because we are entering into close to summer. March will be very hot. And the sales of ice cream and curd will be much better than what we have experienced in October, November, December, which has been completely rainy here.
Okay. And if you can just give me an outlook in terms of your both top line and bottom line for the coming quarters or maybe for coming years, what is the number that you're aiming at?
We may cross 2,000 crores without any difficulty for this quarter and with a little better profit. Profit I'm not able to say immediately because we will also be spending on advertisement and all that. But definitely as a growth as well as margins can improve in this quarter compared to the last quarter.
Okay, thank you so much for sparing your valuable time, Mr. Chandramogan, and giving us your exclusive interview with NDTV Profit.
Thank you. Thank you.
Hello and welcome to NDTV Profit. You're watching the Small and Mid-Cap Show, and I am Vishwanath Nair. We're discussing RBL Bank and its financial results, which came in last evening, where the bank announced a net profit of about 230 odd crore, which was up about roughly 12%. The net interest income, or the core income for the bank, was up about 21% at about 1,546 odd crore. The gross NPA ratio, of course, dropped by roughly about 10 basis points. You've had the net NPA ratio also dropping about 2 basis points. Now, of course, the net profit for the bank has grown slower than the NII, primarily because the bank took a contingent provision of about 151 odd crore against investments in alternative investment funds. And this is coming in after the Reserve Bank of India changes guidelines on how bank investments and NBFC investments into AIFs can be accounted for on the book. I have with me Mr. R. Subramaniakumar, the MD and CEO of the bank. Mr. Kumar, welcome to this conversation. Pleasure having you, sir.
Yeah. Very good morning.
So the first question I have is with regard to this AIF investment provision. You said about 151 odd crore. I was on the call with you yesterday where you said that the actual NAV of these investments is about 160 odd crore, much higher than your investment, and that you really never had any kind of stress with regard to this portfolio. It's just that the RBI guidelines changed and therefore you had to make this provision. If you can tell us a little bit more about where this stands.
Yes. The first thing is our total investment in the AIF is in the range of 120 crores, 120 crores only, out of which we made a provision of 115 crores. And all this relationship, as if you look at it very, very closely by us, these are held by us for the last 8 to 10 years. And our share within that, all this AIF is in the range of around 4 to 5%. And there's no impairment has been seen on those assets which has been on lending or downstream lending by AIF. Since, despite not having a stress on the portfolio, we complied with the guidelines because the guidelines were plain and simple. You have to make whatever the investment you have made in the AIF, if the consumers or if the customers are common between those with whom you deal with and those the downstream they have funded, you have to either liquidate it or you should be in a position to make a provision. There is no distinction between that, the status of it. However, we made a thorough study of it. All these are in terms of tech and digital enhanced investment which has been done. All this, we have not seen any stress as per the information which we have been receiving it from AIF. However, as a prudent measure, as an organization which believes in compliance of the regulatory guidelines, we went in straight and then make a provision, which is contingency in nature. And if I ask me what is the net asset value of these, today it is 161. That means my investment of 120 is well protected. And it also have multiple options. We have not explored any options now because the time available to us for taking a decision was very short. And we took a very cautious and the prudent step of providing for maybe in next couple of weeks, we will just explore further options available to us because there is always, there is a redemption option is always available to the bank. We will exercise the appropriate option, taking into consideration the current relationship, the return on the profitability of these investments, and how these investments will fan out as per the regulatory guidelines. And we'll take a call which is prudent for the balance sheet of the bank.
So would you be looking at any future investments in such funds?
That's what, right now, we don't have any plan of such kind of investment. But however, the current investment, we want to review very deeply about it. And we don't see any stress in it. And that is why it is a contingency or a prudent measure we have taken it. With regard to the future investment, we'll take a call as we move forward. We don't have any such plan as we have it on the table today.
Is there any insight into when you'd be able to write back these provisions?
That is a bit difficult to say right now because we haven't evaluated completely. We have collected all the data. What we came to know is that the exposure which we have as well as they have, we don't see any impairment in those assets. That is only one small conclusion you could make it. And we will evaluate it as we move forward in next couple of weeks, then we'll take a decision.
Okay. Staying on the asset quality question a little bit longer, I just wanted to get a sense of what this quarter looked like in terms of slippages. Now, analysts are pointing out that a bulk of the slippages during the quarter were from the credit card portfolio. However, your upgrades and recoveries have more or less addressed those slippages. So if you could just give us a little bit more color on the slippages and what the outlook looks like there.
You know that the credit card as well as microfinance per se, the business itself has this kind of slippages, which we have already said. Instead of giving a guidance on the slippages, we have given a guidance on credit costs. Our credit cost guidance has been within the range of 1.5 to 2%, and when we are pretty confident about the fact that we will be within that range. So going forward also, we'll be able to maintain the range of 1.5. Maybe if you look at it, whatever the credit cost which we have incurred so far, last quarter was around 47, 48 bips. And we are in the range of around 1.6 to 1.8 now. We will be range bound. Second important thing is that we realize that the recovery and collection is very, very important in respect of these kind of exposures. So we have strengthened our recovery and collection mechanism. We are focusing on 0-day collection, and which we feel we don't even allow it to go to the first bucket. And I can say with the lot of happiness that we were able to get back to the collection efficiency of 99.41% in our microfinance. And even in respect of the credit card also, that the recovery percentage has moved up substantially than what we are seeing it in a couple of quarters before. So these two things, and our special focus on recovery from technical written off account as well as the NPA, wherein we are confident that we will be able to recover more than what we did it last quarter. So we will be able to keep the slippages in check.
Okay. I want to also tackle a little bit about the credit card portfolio itself. Now, during the quarter, there were news reports talking about one of your partners. Now, I don't want to ask you anything about the partner or their future with the bank, because I want to focus on RBL Bank itself. Over the last few quarters, you have said that you have tried to do a non-Bajaj credit card portfolio, building that alongside the existing Bajaj Finance portfolio to try and have your own business. You've also talked about other partnerships to try and diversify this co-branded business. What is this attempt to build this other business looking like for you? How fast do you want to grow it, and where do you want to see it in, say, a year or two?
See, what I would like to say is, first of all, the credit card per se, the business, we have acquired an enormous amount of insight, enormous amount of ability and capability to manage. And having said that, we have the partnership model which is just going up, and we articulated very clearly that the current partnership, what we enjoy with that Bajaj as well as the others, as extremely good partnership, and we cherish that partnership. We have been doing a good business in that. Well, keeping the other point, whatever the news report said about to rest, internally when we look at it, we wanted to say two things. We will continue to do that business with that Bajaj as long as the relationship and our joint partnership indeed is valid. And the second one is that as a prudent banker, we look inward. First, we have decided to develop our own capability to do it, which we have already started doing it in last 2 quarters. And we have placed around 2,000 plus DSTs on the floor who are working from the direct sourcing channel for the bank. This is primarily with the intent of reducing our cost of acquiring. The second, our ability to get the co-origination of these cards with the savings fund account, a term deposit account, and a recurring deposit account is also work in progress. So when we acquire a customer through this channel, we wanted to make him as a sticky customer with the bank with the multiple products, so that my wallet share of the customer increases. That is also another the side impact or the effect of sourcing it internally. The second one, which we have just started, is that our branches started sourcing it directly through our existing relationship, which is in the range of somewhere around 20,000 plus. We are able to get it even today, and which is a fairly good number than what we started a couple of quarters before. The third important thing is that we are in the process of tying up with the multiple other NBFCs and other public sector units, which you will be hearing it in a couple of. These are all for the simple purpose of diversifying our relationship, so that we are able to grow very systematically and in this card business, while we focus on growth of our secured retail in a big way. The rate of growth of secured retail product will be higher than the rate of growth of the unsecured, which is a credit card. And however, having done that, we will be scaling it to the proportionate to that of our existing product. We have already clearly told in our 2026 vision document to what extent we will be able to grow and how we will grow. We will continue to maintain that guidance, and we are pretty confident of even achieving that guidance.
Just for the benefit of viewers, where do you want to see this as a ratio of your total book?
If I see that in 2026, we are looking for the total exposure of our secured retail product in the range of around 30-35% of the total balance sheet. And we will be having around 23-25% will be in the credit card and 8-10% microfinance. Another 30-35% will be commercial banking, wholesale banking, our MNCs and new economy and our IFI and NBFC business. So this is how it will be looking like in 2026.
Okay. I want to shift focus.
You would have seen, sorry.
Yes, please complete.
Yeah, and you would have seen that last quarter, we are moving in the right direction. Our total advance growth was 20%, and our retail growth was 33%, and our retail secured growth was 50%. So the tractions are on the same direction, and we are confident, having established or invested in the manpower as well as the systems and procedures, systems and processes. We are pretty confident of maintaining it for 1 or 2 quarters. Thereafter, it will moderate. Going forward next year, our advances will be growing in 20+ range, and within that, retail will be growing in 25+ range, and within that, the secured will be growing at 30+ range.
Okay. I want to ask you one question around the operational side of the portfolio on the advances and deposits. Advances, you've seen strong growth on the retail portfolio. Commercial banking or the wholesale banking is up about 6-odd%. I want to understand from you where you see this going forward, because you said that secured retail as well as commercial banking is mostly going to be comparable in terms of the size by 2026. So you would have to increase the pace of growth on that on the wholesale portfolio as well, if I'm not wrong.
Yeah, correct. If you look at it, we have been growing our total wholesale business in the range of around 6%, because it is mostly the corrections are happening within that. The correction in a sense that the one which is giving a less yield or the moderate yield are giving way to that of the retail secured product, which is able to give me a mid-range rate. This correction is happening now. That is why you are seeing it in the corporate. But going forward, when the balance sheet grows, proportionately there will be a growth in wholesale business also. But within the wholesale business, our focus will be on the commercial. When I say commercial, it is our medium-sized industries and SME segment, which are having a turnover in the range of around 100 to 200 crores, and which will be requiring a bank finance to the tune of around 50 to 100 crores. Why we are looking at it is that we will be moving down to tier 2, tier 3 locations, for the reason that we will be able to single banker for that kind of exposure. We will be in a position to get all the allied activities on trade finance and forex and export and import, and all the activities will be routed through us. This is going to increase our fee income, so that the margin which we earn from the wholesale book, which is in the range of around 0.8 to 0.9 today, will move up to 1.3 to 1.4. And so that when the margin moves up, you have to have the combinations and the corrections going to take place, which will help us to kick up the business as well as the profitability. The entire focus is on the bottom line, which you would have seen it. We were able to throw. Other than the AIF, if you put it, our PAT growth this time is 53%, which you will appreciate that it is one of the finest. Although you can't have that 53% in year on in every quarter on quarter. But however, directionally we are in the range of increasing that PAT multifold. AIF is again not a provision which is an impairment. We are confident that we will be in a position to get the best out of it as we move forward. It's a prudential one. So the primary focus of PBT and operating profit focus. So if you look at that operating profit, it has also grown by 35%, which is a clear indication that we are in a position to leverage our investment, which we have been making it in the last 12 to 18 months. First is that our other income is almost equivalent to that of our operating profit. The second, the 9 months operating profit increased by 33%, whereas advances increased by 20%. That means we are able to leverage. Operating leverage is something which you are seeing it. And going forward, we are pretty confident that we'll be able to maintain the momentum.
Okay. The last question I wanted to talk about is the liabilities question. Of course, for banks, that is the most the sort of the crucial question for at least during this financial year. Your liabilities growth for you as well as the system has been slower than the advances growth. I'm trying to figure what the outlook is like, because yes, there is a CASA component that needs to also grow. You're one of the few lenders which offers a higher rate of return for savings account rates. But what is the outlook looking like? Are people going to, do you think that going ahead you will be able to attract depositors just with the rate question, or is there anything else that you would like to focus on?
As far as our bank is concerned, we are in a very, very special zone, in the sense that we have around 530 branches only. So our ability to reach out to the customers in that range is restricted to 538 locations. First focus will be that how do I increase these locations multifold? That is the first step. So we just in Visage, we found out, we have just looked inward and saw that around 1,200 BC branches are operating with the tag of RBL. So we are already doing a business there, and which is in the range of around 6,000 to 7,000 crores of the loan has been disbursed through these 1,200 locations. Now we have created a footprint for us. Why can't we leverage those locations for accumulating or augmenting our liability was the first thought we went in. If this is to operate that, the cost of operation should not be prohibitively high. So we need to, already we are paying a high rate of interest, as you rightly said. So we started looking at what are the alternatives. Then we developed the concept called the digital banking for them. The digital journeys for accounting savings fund account, engaging with the customer and servicing the customer and managing the requests of the customer, everything has to be a digital journey. So the digital journey for term deposit is ready and tested, and it is being piloted. And savings fund account has been ready and piloted. So these 800 out of 1,200, we have narrowed in for 800 locations. So 800 plus 538, we will be getting 1,300 locations as the start of the Q1 of next year. So these 500 locations are augmenting X amount, and 1,300 will definitely augment in the, if not 2x or 3x, it will be definitely X plus Y. I give a simple example. If these branches are able to augment just 10 lakhs per month, 800 into 10 lakhs for 1 year, they will be adding 4% of the total deposit, which we will be able to add up to that. So our ability to source, even with the minimum sourcing, 4% increase is going to happen because of this increase in the number of touch points. The second, we already have a very good the customer base in terms of credit card, MFI, liabilities, and our commercial and other activities, but we have never leveraged them beyond that 1 point of product. Now we have started the cross-functional sales. Already the digital journey has been started for CC customers to open SA. Because one KYCs we are very, very clear about, that we don't want to get into the same customer to ask him for the KYC or opening savings account. If he's already a credit card customer or a microfinance customer or a savings customer, he can get other products with the same KYC, unless otherwise any other additional information is required as per the regulator. We will be in a position to bring them on board quickly. The digital journeys regarding this are ready. And in fact, during a pilot, we were able to open 50,000 accounts of our credit card customers into savings fund. So this is the ability we have just created, and this will also facilitate us to increase our liability. The third is that this liability product, which we have been giving it as part of the loan. For example, tractor loan. We saw that 400 crores of disbursement in 1 quarter, and the total 6,000 crores of disbursement in retail assets. All these assets are mostly secured, and they are the housing loan lab, which are going to have a long-term relation with the RBL. So we are creating a co-origination journey for all of them, so that all of them will start using our liability accounts, and the EMIs will be made through the liability account. The moment we have started funding their account, because to meet the EMI, our ability to engage with the customers goes up. So to meet our requirement of the growth, we will be able to mobilize sufficient amount of deposit. If you look at our the philosophy on balance sheet management, we said we will be granularly looking at both assets and liability for the growth. And as far as the asset is concerned, I already shared with you, and you are also well aware that how granularly we are going in respect of the asset growth. In liability, again, we have done 23% growth is seen by us in the retail space of the liability. That's a retail deposit. So less than 2 crores, we are able to mobilize 23%, whereas our advance growth is in 20%. So incremental advance growth will be met by this granular deposit itself, which is stable in nature. So the entire philosophy is working well, and we are confident it will work very well as well.
All right, Mr. Kumar, we leave it at that. Thank you so much for taking time out on a Saturday and joining us on this conversation. And thank you so much for watching our viewers. You're watching the Small and Mid Cap Show.